this is pretty cool. I want to talk to you about a lot of different risks that nobody talks about. I'm going to kind of go through a laundry list of risks that nobody seems to be concerned about. Everybody talks about stock market risk. We know about that. But what about something called inflation risk? Now, inflation risk means that the purchasing power of your dollar is not keeping up with inflation. The best example of something that's out there that tries to keep up with inflation is, believe it or not, Social Security payments. In fact, they call it COLA, or cost of living adjustment. And while we would argue it isn't keeping up with inflation, if you look at the price of eggs and toilet paper, it's at least trying to. So yes, it is a real issue, folks, that inflation will outpace what you're earning, which gets back to my premise. If you're going to try to keep up with inflation, you have got to dip into that principal plus interest. It's going to be hard to do it on interest alone. The next risk nobody seems to talk about is interest rate risk. Now, interest rate risk is a funny thing. Interest rate risk occurs when you invest in secure products. Let's take short-term bonds or government bonds or fixed interest annuities or even CDs. And what can happen is you lock up your money for that period of time. Whether it's a 5-year annuity or a 30-year bond or a short-term bond or a 2 or 3-year CD. And what happens is you get that interest rate locked in, but what happens if interest rates go up? Well, if they go up, the value of what you had goes down, especially if you surrender it. So interest rate risk is real. We can show you how to combat interest rate risk with a game plan. The next risk, I call this stock market crash risk. Aaron, let's put this up full screen for them to see again. This is an example of a stock market crash, but it just wasn't in 2008 that there was a stock market crash. Look at the laundry list of years over time that the stock market has gone down dramatically. So we know the stock market's going to go up and down. What we're worried about, folks, is stock market crashes, and not when you're 35, 40, or 50 years of age. We don't want that stock market crashing when you're retired. So don't buy into this notion that you got to take all this risk when you don't have to. It's ridiculous. Next, surrender risk. Now again, folks, you know how much I love annuities. They're great products, but many of you are rushing out and buying annuities from annuity peddlers, or you don't even have a game plan. And what you don't realize is if you bail on that annuity earlier than its term, and many of these terms are 7 to 10 years or longer, the insurance company is going to hit you with huge surrender charges. So rule of thumb, do not put all of your money into an annuity because you're going to get tied up in there and it may be hard to get it out, or you're going to incur surrender charges, or spread the risk over different surrender dates within those annuities. This is why, if we can put this up, Aaron, this is why we offer the split IRA concept. We do not want all of that money in annuities because of the surrender charge risk. The reason we have the Charles Schwab bucket is so we can get that money out lickety split anytime you want without any surrender charges. So again, be diversified. Don't put all of your money in one annuity. And for goodness sake, before you let an annuity peddler throw you an annuity, see in writing what those surrender charges are going to be before you buy that annuity. Next, it's the greatest fear of all Americans out there, and that is the fear of basically running out of money. So longevity means how long you're going to live. That's really what that means. And what people are trying to figure out is, well, I don't know how I'm going to live. So where am I supposed to invest my money to make sure that doesn't happen? This is why, folks, we use annuities. And again, we're not going to put all your money there, but the annuities, especially if it has what's called an income rider, or if you annuitize that annuity, the goal of the annuity is to make sure you don't outlive your money. So, for instance, if you have a long life expectancy in your family, maybe you're in great health, the longevity risk means you need to be careful. If you've got all the money in the market or even in other assets that don't provide guarantees, yep, you one day could outlive your money. Not good. Next, sideline risk. Now, what is that? Well, let's use the example of happened in the pandemic. When the pandemic happened, the stock market crashed. It might have been you. You were in the 401k at work. You got nervous. You were losing money. So you kind of put it on the sideline. In other words, you contacted your custodian. You said, get me out of the market, put me in a stable value fund. The problem with all this is, now that several years have gone by, assuming you left it on the sidelines, follow what I'm saying here, now the market's gone way up and you're feeling guilty because you missed the rise of the market. So here's what I would say with that. Sideline risk usually occurs because you are trying to time the market, which is something we do not advocate. What we advocate is keep it diversified. Don't try to time the market. Whatever you have in the market, which for most savers should not be a lot of money, but whatever you have there, let it do its thing. Make sure you have a game plan that allows you to feel comfortable in taking some risk, but also knowing that you're not totally on the sidelines if you do want to take a little risk. Next, liquidity risk. The biggest problem I've seen in doing this 40 years, here is the biggest problem. Most of you have way too much money in your 401k plan. Yep, I said it, and you're probably thinking, I've never heard of such a thing. The problem is, folks, when you get into retirement and you've got all this pre-tax money that has not been taxed yet, when you go to take it out, it's all taxable, meaning it could throw you in a higher bracket. There's problems with things like IRMA and Social Security taxes. Or you might retire early and you're trying to qualify for Obamacare. Well, all of that money that comes out of there is all fully taxable. So the majority of the people I meet have way too much in the market in their 401k. What they don't have is enough money in after-tax savings. Yes, even if it's at the bank earning 1%, I could care less what the interest rates are on this kind of money. You have to have money accessible, liquid, and it needs to be substantial to cover emergencies, things you might want to do in terms of gifting, or even to supplement income. So we can help you figure out how much money you should have that basically is in liquid positions that's after-tax money, so you've got the flexibility to deal with retirement.
Thanks for watching. We hope you enjoyed that video. If you'd like, check out these other clips. And be sure to hit that like button and that subscribe button for more videos.